to get started on the second quarter Q&A. We're going to do this one in a format where we're going to cover just different operating points in order and touch base on all sorts of different deals that we're going through. Obviously, we have everything from retail to flex to apartments. So we're going to dive into operational items first, and we're going to go through a couple different things that we saw happen in the second quarter. So if you have any questions along the way, you can type them into the chat box. They'll show up right here. We can hopefully answer them in real time and get any answers over for you. But a lot of these too are questions that did come through when we were doing our end of quarter review. So we'll get started. So first one that we had, there were questions on Pleasantdale Flex. And this is an industrial flex deal we have. And it was basically, when are we going to start to see distributions and how is the project progressing? Kick off on that one.
Yeah, so we bought the project in November. We were over there last week driving by, and there was some serious work being done in the parking lot. And we have 4 tenants there, and one of them's on their way out. And really, the business plan was fairly simple. It was rents were $2 to $4 a square foot, and market was closer to 12, 13. And it's really to negotiate with those tenants to stay, renew at higher rates, or to turn them over one by one. So we're in progress with one of them and negotiating with another one. And
yeah, we have some other videos on that one out too, where we demoed a huge portion of the back structure shed thing, and then cut down a bunch of trees, curbing, parking lot, all that stuff. So that one tenant is out. Distribution wise, we can't really make distributions until we get that leased and paying rent. So there's a difference between lease, they'll move in, and then they normally get 2 or 3 months of an abated rent period. So as that happens, then we'd start making distributions. So we're anywhere from like 3 to 5 months away from that happening on the deal side. Okay. Another question came in on the VA clinics. So we purchased a couple of these clinics, and it's kind of a 2-part question. We have 1824 and 1830 Hillendale, which are up in North Carolina. But overall, we've sent out a bunch of announcements lately on the fact that the VA is doing this big infrastructure build out, and they're going to spend, it was crazy numbers, $1-2 million per location to build out new IT going into that space. But really, none of that's really happened. We have not seen any momentum on them doing that work with the government. And even the 2 locations we have, 1824, 1830, the main contractor that the government uses on many of those throughout the country essentially said, we're tired of negotiating, and they don't want to do the work because it's taking them too long to get started. So while we thought this was going to be a positive, where they'd say, hey, they're going to spend a lot of money to stay in space, really nothing's materialized from it. It's out of our control. It's not something we can do, but we were hopeful that they'd be doing that work.
And just a quick refresher on the leases there. So 1830 we bought with a fresh new 5-year lease. So we're roughly 2 years into that lease. And 1824 we just got them to sign a 3-year extension, and we were able to basically renew the loan with the bank for a full 3 years.
Yeah, we had 1-year leases at 1824. Signed 2 1-year leases. Now we got a 3-year lease. So slightly longer, which is great. But yeah, overall we're just holding strong there. We had a lot of CapEx dollars at 1824 that we're now no longer going to spend because they signed the lease renewal. We don't need to spend those dollars. So we're going to look at seeing how much we can return to investors on that asset. So, okay, next one we got here is I want to talk a little bit about our apartment rental growth, because some of that we're looking at our deals and people are then asking, how is our margin performance at it? How are we performing on the investment side? So they're getting better or worse, or why are we holding some versus selling others? So overall, on the apartment side, we saw revenues are still up. They're still growing year over year, but now we're starting to see that taper off pretty dramatically.
Yeah, it's really, the revenue's still up, but they're not growing as fast as they historically have. So, our properties are still performing well. Net income growth is still going in the right direction. And, our general opinion is that, this is where operators really outperform the flippers in the market. And where there could be some buying opportunities where the guys that were buying with the 2 and 3 year holds that were looking to get in, juice rents, and get out, they're really not in a position to do that anymore. So we could see some buying.
Yeah, that goes in. I mean, that goes in trends. Andrew, your apartments you first had, you had flat revenue for years, right?
Yeah, from like it was approximately 03 to 08 or 09. Rents were pretty much standard. It was 650 or 600 to 650 for 5 years, 5+ years.
I think median rents now are around $2,000.
Yeah.
So significantly higher.
Basically from 2009 to now is when the rent growth started every year religiously. And now this would be 14 years later, it's going down. So you had 4.
So I mean, right now, year to date, we're a decade of rent growth. Right now, we saw 7% run rate gains, which is year to date 7%, which is the first time it's been under 10%. 5 years, 4 years.
Right. And that 10% is not sustainable either. It's just,
definitely not.
It would.
So, but if you modeled it as, hey, it's going to be 10% forever, run into.
That would be awesome.
Model looks awesome.
The model looks
for
great.
owners, not for a renter. Yeah.
So we're seeing slightly lower rent growth, which realistically, I mean, we were never projecting 10% anyway. So we're fine with that. But that's certainly something that's happening on the margin standpoint of that. Operating wise, we're just focused on controlling the things we can perform, which is predominantly maintenance and time to lease. We just keep working on our metrics of how quickly can we get maintenance tasks done, completed correctly, and how long does it take to lease. That's what really drives our operating margin. Those are the numbers we've always focused on. So nothing really is changing on that front. So let's see. All right, we got some questions on our net leases. So some of the questions came in. We have net leases where we know we're not responsible for anything. And we have double net leases, which is a lot of our retail centers that have annually we could be responsible for things associated with the parking lot or roof structures or building exteriors. So
Landscaping.
yeah, we're not fully net. So we have some stuff. So question was like, are we seeing any cost increases there or any cost liability on our side?
So like the triple net leases would be like our Applebee's or our Zaxby's, with the tenant is responsible for doing everything. Whereas the Dollar Generals would be called something like it's a double net lease, and typically we're responsible for roof, exterior structure, parking lot, and also landscaping. Honestly, it ends up just being landscaping, and plus Dollar General gives us a landscaping allowance every month anyway. So really, every 5-7 years we have to plan for a parking lot, seal, restripe, and occasionally Dollar General might just paint the building itself because they want the building to look nicer, or they might request us. But so far, the only expenses on our Dollar Generals have basically been accounting expenses, basically our tax return every year, and our yearly inspection that we actually go there and we figure out, okay, what needs to be done, what capital expenses do we need to plan, and really that's it for our Dollar Generals right now.
Yeah, so that annual inspection, that's what we're using to say, are there any issues with the roof? Are there any exterior issues? Versus us just driving by and looking at it.
Right, and we also make sure the tenant's doing their job and taking care of the place too. So it's kind of for both.
Both sides.
Yeah. So for one of the problems we've noticed with Dollar Generals is there's a lot of trash near the dumpsters, and so we have a process of, hey guys, and we kind of have to tell mom and dad on the store and say, hey, your store's not keeping up with your trash. Can you do something about it? And then they,
trash is like a never-ending.
Trash is never
issue on every property we have. There's always like, how do you keep the trash? How do you get people to put trash in the dumpster?
But overall, all of our Dollar Generals are right on plan, pretty much exactly like the offering stated. Yeah. So they're all been minimal.
And I mean, this quarter we made distributions on all
of them
retail deals, so it was all going smoothly. And we don't really see any outsized risk or issues right now with the exterior structures. We're in good shape.
We love our Dollar Generals. Yes.
Cool. Okay, another question came in, and this is something we've been going through on one of our Applebee's lease renewals. It's not really a lease renewal, it's like an ownership transfer that we had. So we want to go into kind of what that situation was and what happened.
Sure. I'll try to cut it to 3 minutes, right? 3 minutes. So just very briefly, Applebee's or Dine Brands owned a 69-unit portfolio of Applebee's restaurants, which was taken back from a franchisee many years ago. And so the only franchises or restaurants that Applebee's corporate owned were these 69 units. Those 69 units then were sold to another franchisee called Thrive end of last year. And we have two of these units that were sold, our Seneca Applebee's and our Sumter Applebee's. Both of them were sold, and the way they did the leases is they actually separated the 69-unit portfolio into a North Carolina portfolio and a South Carolina portfolio. So the North Carolina portfolio is probably about 40 units, and the South Carolina portfolio is about almost 30 units. I think it's like 27 units. And so with the Seneca location, the lease was actually assigned to the 27-unit operator, which is okay. It went from a 69-unit guarantee to a 27-unit guarantee, which is still pretty significant.
It's still a big operation.
Still a big operation. And our Sumter deal, they assigned to a single purpose entity, which is a little bit of a challenge for us. And we're navigating our way through that process right now, so that our Sumter Applebee's is essentially owned by a single purpose entity, which runs that one Applebee's, which is then owned by the 27-unit Applebee's Sumter LLC. So it gets a little confusing to navigate, but really what it amounts to is the strength of the Applebee's Sumter lease is a little bit different than it was before. And we're trying to work with the franchisee on getting the strength back for that lease right now.
I mean, and that's the same approach we use on all of our deals. We're always setting up single purpose entities to hold something. We don't hold anything, collectively.
And
But
there
we
were
don't
some,
want the other side to do it too.
there were valid reasons why they did it. So if they're sued, someone falls in their restaurant and, there's only a single purpose entity behind it. And so they can only sue that one single purpose entity. And there's reasons they did it that makes sense. And there's other reasons that kind of compromised some of the guarantee on the lease.
Yeah, obviously on a lease guarantee, what we're looking for is the best guarantee we can get. We want to have whoever guarantees it have more money, more assets, more things to make sure that they're going to pay that rent. So when they change that, kind of stirs up the hornet's nest a little bit, gets people agitated. So
Yes.
we're still going through that and discussing that with them though. Yeah. All right. So we want to touch base a little bit on West Side Crossing. So West Side Crossing we just sold. That was our deal number 33. It's here on the west side of Atlanta. And we got some questions around the timing of the sale and what was the cap rate when we sold it. So we sold it at just under a 5 cap.
Yeah, 4.9 cap based on the trailing 6 months of operating history, which is pretty phenomenal. The market right now is probably closer to a 5.5, 6 cap. So we're pretty excited to realize that. And probably half the investors decided to do the 1031 exchange with us, and we're looking at what the next asset could be.
So that was a 112 unit apartment deal, and we owned it for 7 years. And over that 7-year period, we generated roughly 18% IRR on that whole time frame. So we were excited about the deal. It was a very good exit. I mean,
and give yourself some credit. I mean, over 7 years, that IRR is phenomenal.
It's hard to keep an IRR growing.
20% IRR over 3 years is pretty good IRR, but over 7 years, that's pat yourself on the back for that.
Yeah. So we're very happy with that deal. And we're looking at what we're going to do next with some of the proceeds from that. But when we looked at selling that deal on the operating side, we're getting certain assets that have more challenges with the rental payment status, essentially. Right. So this is City of Atlanta. Right now, the City of Atlanta has about a 2,600 unit backlog of evictions that they're trying to process. So we had tenants at this property that had been 12, 15 months more that they hadn't paid any rent. And obviously that makes it a challenge operationally going forwards. And we don't have this across the portfolio as a whole, but there's certainly specific assets that we've had hurdles with there. So those are the ones that we've been exiting. We're looking at exiting Rosecroft as well.
Right. Yeah. I mean, ultimately it comes down to is, we look to buy properties, invest in them, improve net income, and keep investing in that asset to really improve the situation. And when we get to a point that we can't do that and there's outside influences stopping us from doing that, that's when we look to sell. Like West Side Crossing, like we're not going to change the City of Atlanta's eviction process. And we've turned around other properties in the city, just this one was specifically having a problem. And so we decided to move on.
Yeah. So Rosecroft is deal number 41. That's the next one on our transaction list that's happening August 10th.
Yep.
Is our plan right there? Another point, we got some questions on the Opportunity Zone fund that we have. Now that's a much bigger investment. It's got a bunch of assets that go into it. But in general, we sold deals that were in the QOZ fund. And originally our plan was to hold all those deals for 10 years. It looks like our plan is going to be to sell deals in the Opportunity Zone Fund. We've redeployed that equity into the existing Opportunity Zone funds we have. So if you look at the balance sheet, it shows increased investments to the deals we have. And then even those deals, we're most likely not going to be holding them the full 10-year period. So we'll look to exit those and roll that into other Opportunity Zone deals that are out there. Right now, one of the ones we're working on leasing is 1500 North Graham in Charlotte. But we've had about 20 tours this past month. They're all looking to just buy.
Right.
So,
Yeah, it really, you know, the early stage of the Opportunity Zone Fund, we bought 3 apartment complexes. The backstage was the office buildings, and really, well, the apartments were able to turn so fast versus the office buildings. And now there's we sold one apartment complex. We have the 2 other office buildings really coming now to maturity of now let's lease them. And the office market's a little bit softer than it was, say, 24 months ago. And there are, with the size of the buildings, there's a lot of owner users that are very interested in them, much more than rental users. So it's probably more likely that we'll sell that to an owner user than find multiple tenants for them.
yeah. So that's the trajectory we're taking right now with the Opportunity Zone. Through the tax aspects of that, as long as we're redeploying into Opportunity Zone assets and then improving those assets, it keeps going. All right, no other questions here. So we're talking a little bit about capital improvements. So we're always doing something on the capital improvement front.
Always spending money, right?
Spending money to make improvements, but
Yes.
we've got the main stuff we're doing right now is in the flex space. So we've got 3 big CapEx improvement projects right now.
We talked about Pleasantdale a little bit. Let's talk. I mean, Dawson's this tremendous success story that we went in. You know, we bought this roughly 80,000 square foot flex property, and with a plan to really break down into smaller units, spend quite a bit of money, what, $2.5 million?
Yeah.
To break it down into smaller units and lease it to multiple tenants. And really, in the middle of that plan, we were interrupted by 2 larger tenants that wanted more space, and we don't have to spend most of that money on breaking it down.
Yeah, so we're not going to divide it up, but you know, we are going to spend money on TI just to improve everything that's there. And that one, we leased 60,000 square feet. We've talked about this a little bit before. And one of the tenants is fully in and they're paying rent, and the other one will be fully in and paying in November. So we're going through everything there, from sprinkler systems to new roll-up doors and a little bit. I mean, they all have some office build out in the front of the space. So, you know, we're doing some of that build out. But we're making great progress there, and that one's going pretty darn quick. And it's a mix of this flex space where we're taking really a white box and saying, what do we want to put in here? But that keeps us kind of bullish on the investing in the flex space. So we know we can go take something and turn it into something a tenant is going to want to use fairly quickly.
Right. And which really leads into the property that we bought in March, Lakeside Flex, that we're really just starting to kick off that construction project now. You know, it takes us about 90 days to really get our boots on the ground, get all the vendors lined up, get permits, et cetera. And now we're about to launch that and basically start renovating and leasing.
Yeah, Lakeside, we have 35,000 square feet that we can essentially do the same thing with. In the middle of that, between when we closed to now, we've had 2 tenants come to us, ask to expand. So that's an additional 8,000 square feet that they're going to eat up, just taking their current footprint and expanding it a little bit. It's 120,000 total.
It's close to 200.
In that one building.
Oh, that one building, sorry.
So I think of that one,
Yeah.
But so we got a little bit that we're just going to rent to existing tenants. The rest we're going to then turn into the flex true space, roll up doors, and bring it all out.
And really our success that we've had with these buildings and really looking forward is really going to kick off our next project that we'll send out on later this week, called Forum Flex, which is really just more of that Lakeside story.
We got to come up with interesting names for flex assets, but we came up with Forum Flex because it was called Lakeside. We didn't want to call it Lakeside number 2. Yeah, so it's Forum Flex, but similar scale, similar story, and a great opportunity just to add into the flex space. And that one's interesting. The buildings around it. How many buildings? Like 12 buildings, all purchased by one person around it. That they're going to convert not to flex.
Right.
They're going to remove the flex that's there and do medical build out for that. So that's exciting. We'll basically just be right on the border of that huge development. So we have more information on that one coming out. It's pretty cool to see. So, all right, next part, kind of consolidate all the questions we had around financing and debt. I mean, we've talked about interest rates for a while.
We talked about
Too much?
too much, yes.
But the financing part is unique in that right now we're seeing lenders, they're not turning capital as fast. So they're not issuing new loans and loans aren't being paid off. So anytime you kind of have a challenge in the market, like eventually something's going to fill that gap. And the question was, are we going to see any private financing kind of step up and be an alternative to typical banks? And what opportunities come from that? And we have one opportunity right now. You want to talk about that one where you have a seller finance opportunity?
Yeah, so it's a very traditional flex deal that we've looked at, and we were actually been negotiating for about a year now. And as the market really evolved, the seller came to us and said, listen, I'll sell it to you, but I want to hold the paper. So he's willing to lend to us, 65, 70% at 6% interest rate. And it actually looks pretty interesting, but it looks better than bank debt rate.
Yeah, better rate, easier to work through with that person. You know, banks require a good amount of information, which is fine. We're happy to do all that, but this one's pretty smooth with the seller. So we found one opportunity that's really, we've had other people mention seller financing or mention that kind of debt before. We haven't seen anything get as far as this. So I think as the market continues to stay tight for probably longer than we expect, or longer than people think, more of that will probably pop up, give us some good opportunities out there. But that's very much, I mean, you've got to get an individual comfortable with doing business with you for years. So most of the time, that takes longer than a bank. So there's definitely a relationship component to be able to execute those kind of transactions.
And really, as the debt markets really stay tighter than they have historically, some of the discussions we have with banks is one of the biggest challenges they're having is that their loan portfolios aren't turning over as quickly as they've historically seen the last 5 years. The deals aren't selling, they're not refining as quickly, that they're not able to lend out, meaning that it's harder and harder to get debt. So as a result, it could create some opportunities for buying.
Optimistic.
Yeah.
We haven't seen anything on the retail side though that
No,
hasn't happened
the
yet.
debt has, in order for the banks to loan money, some of their existing debt has to be paid off or retired, and it's just not happening. The way I think about it is a bus is going to all the bus stops, and the bus has sort of stopped moving. There's nobody getting on and off the bus to move, and so there's still people.
Nowhere to go.
There's still people at the bus stop waiting to do something.
Yeah.
We're kind of waiting at the bus stop, and there's nothing happening right now. Is that a good analogy?
Yeah, I like that one. It's pretty good. All right, so one opportunity on the financing side. We just talked about our transactions. I think going into the year, we expected it to be a slower rate of transactions for the year.
And guess what? You were right.
Sort of ish. Sort of ish. We expected it to be slower, but we're still seeing a good amount of, still seeing a good amount of activity. So one of the questions came up is about our IHOP deal. They're having, that's in Spring, Texas.
IHOP in Spring, Texas. Yes, IHOP in Spring, Texas. We purchased, I think it closed October 25th last year. And we want to get that year of long-term capital gains locked in. So we're going to start talking to our brokers right now about listing that and getting that out in the market again. And we're hoping that'll sell somewhere with a 5 in front of it. But with the market right now, it'll probably sell someplace in the high 5s, low 6s. And so we'll start to market that one soon too.
And that's following exactly what our business plan was there.
It was right. It was we took a short lease, made it a long lease, waited our year for the long-term capital gains sale, and we're going to sell it and make some money. So that's it was always going to be like a year hold. Depending on the market, we'll see how the listing goes. My guess is it'll sell immediately, or it might take a little bit. But we're testing the market right now. We're testing a new economy because this deal may, or because of the price point, it probably will not be 100% cash deal because it's a higher price point. So it'll require some debt, and so we'll see what happens with that. But we love the IHOP. Honestly, if it doesn't sell, my feelings wouldn't be hurt because it's a great asset. It's in Texas. It's an IHOP.
It's 185 degrees there, but
I thought it was 195 degrees.
Yeah, maybe. But I think we look at our investment strategy with the retail deals like that on the transaction side. It's we're going to buy something with a short-term lease. We're going to extend that lease as long as we can, and that's the point. We want to sell when we have the most amount of time left on that lease. If we're in the middle, we're going to wait until we get a renewal and have a longer-term lease to sell at that point.
Right. So I like to tell you all the time, the best time to sell the deal is the day after we get the lease bump or a lease extension. That's the time it's going to be worth the absolute most.
Yeah.
So that's the time to sell.
So if we're kind of in the middle on the time frame, we're very much looking for that extension date to say, look, this is the time we'll make a decision
Right.
on the capital side.
But honestly, some of our properties we just really like too, and they continually cash flow, and every year they're just going to cash flow more because of rent bumps. And so there's those type of properties too, like the Zaxby's assets we have. We have a great operator relationship. They all cash flow really well. And so, you know, I really like those assets personally.
Yeah. Let's on transaction side. We got another question here on Applebee's and Panera. So if you recall, we purchased an Applebee's in a strip center. A Panera in a strip center that had a vitamin shop,
Mattress Firm.
And do it.
What's the fourth one? Or third one?
I forget what it was.
Aspen Dental.
Yeah, that's right. One in there.
Good job. Good job.
So I had those three in it, and Vitamin Shop actually was doing really well.
All three of them were doing really
Surprisingly
well.
so.
Yeah.
But we sold that and used that as a 1031 to go buy Applebee's.
To buy
Clean.
Applebee's Clean and Applebee's Sumter.
Yeah.
And so those, we just talked about Applebee's Sumter a little bit, but Applebee's Clean is doing really well. We're paying just under prefs right now because I think we just got the rent bump. We're due a rent bump very soon for Applebee's Clean. So as soon as we get that rent bump, we'll start paying the full prefs. And so they're all operating to plan. Panera, you know, all the assets I like. I think Panera is a great brand to own. And me personally, I like the Panera because I own a piece of it too. And, you know, of all the, I call them nice QSR. I mean, Panera to me is a nice QSR brand and also very stable in the market. And to tell you the truth, I've already talked to the operator once, and the operator is it's a good business partner, and they would be happy to do a blend and extend with us when we want one. But, you know, right now I'm just opting to, we have, I think about just under about 3 years left on the lease. We'll just take the rent bump and go from there, either sell it or
but that'll happen when we do that. Any kind of transaction there would happen when we do that lease. We wouldn't be looking to do it now.
Correct.
So all those right now we're in a hold pattern on the deals that are in that entity structure.
Paying prefs, paying investors. So best we could hope for.
Yeah. We had a question that came in here on the screen too about anything on the Lupton building. So that's in the QOZ fund. It is up in Chattanooga. It's taken forever. This is a technical forever, but it's taken a long time to get our CO and operating there. And now we have the end of our construction period there. And we have 2 leases that we're trying to negotiate right now.
Yeah, so and final, we did our fire inspection, some very minor things came back. We did that work, and now they basically have gone back out for final CO, which we're just waiting on the department to really sign it. So it should be this week.
Yeah.
No more work. They're not asking for any more work.
Well, we've got a law firm there that's looking at taking up space and
in a salon.
In a salon. The salon would be good because it's kind of that retail front area. We see a lot of people. The law firm is on the upper floors to take that space. So we're negotiating both of those where we carve out like what exact area are they taking, and then hopefully get those leases executed in the construction moving on those. Both of those are very much we're saying yes, let's move them in here and just figure out what their exact specs are so we can get that built out for them. So really, we're going to continue down the leasing path there and work on getting them occupied.
Yeah, Chattanooga office market continues to be strong, over 95% occupied. So we're hoping to realize some of those leases.
Yeah, and really, you can put anything in this space. I mean, it's fully open.
Right.
So, all right, let's talk about Midtown on the transaction side. This is probably one of the more interesting investments we've made over the years, and it was a portfolio of really mixed-use buildings that we purchased up in Chattanooga. It's 280,000 square feet total, and everything. We've got government tenants in there. We have medical tenants in there, pure office tenants. We have flex users in there. So a bunch of different stuff, all around $80 to $90 a square foot. So our plan was to go in, take those assets, stabilize each building, and then look to exit on a building by building basis. So we knew it would take us a year, similar to what we're talking about with the IHOP. We want to hit that long-term capital gains situation. It takes us a little bit to stabilize too. So now we're on our year in, and we have 2 LOIs that we're negotiating. One that we signed this week, which is Monday, so that's kind of today. But the other one that we're negotiating with a sale with, one is a medical tenant user, and the other one is basically a service industry user. So
Yeah, but the tenant wants to buy the building, so yeah, owner user.
Yeah, and that's great. I mean, good buyer.
Yep, and it's a great validation of the complex in the area.
Yeah, so we'll do very well on those exits, especially on our return on equity. That's looking very good. So, but it's not necessarily a sale and then that money goes out the door. It is a sale and we have to pay down our note associated with all of the complex there to maintain a debt yield percentage. So whatever we sell off of income, we've got to pay down the loan cost pro rata for that. So it's a little bit of a more complicated exit scenario, but on the high level part, we're making a very good spread on what we're buying versus what we're selling for. And we feel confident we can keep doing that on the remaining assets that are there. All of these across the board, we're going through and doing different CAM reimbursements because we're trying to stabilize those leases, make sure they're paying fully what they're supposed to be paying in accordance with the lease. That really helps clean up the financials and the revenue picture, and it makes it easier to sell at that point. That was really our big value add, is operational value add, coupled with some of the physical value add that we're doing. So, okay, we had another question on 1031 ownership. And I would say our 1031 structures are normally fairly complicated every time we end up doing one. We end up with this structure called a TIC, or a tenant in common, where we're buying an asset and we have multiple entities that own a piece of that asset. An example would be Johnson Square. This is a complex that we purchased. It's here in Atlanta, but it has technically 3 different owners. And within that, each investor has a piece of ownership in that partial owner.
So if I'm on my Juniper portal, it shows that I own 5% of the entity that I'm in. That doesn't mean that I own 5% of all of Johnson Square. It means I own 5% of that one tenant in common, and there's another tenant in common that owns. Yeah. And so it's not a 1-for-1 that your 5% equals 5% of the deal.
Right. So Johnson Square, we have 3 entities. One that's 24%, one that's 65%, one that's 11%. And within those little tranches, your Juniper login is going to show, hey, I might own 10% of this one entity, but that entity owns 11% of the whole deal. So it makes the math extra complicated, but it's also how we're able to take our 1031s and ensure that all the funds are placed by kind of essentially partnering in multiple deals. That's what we're doing on the TIC front. So, yeah. Okay, that's it on questions. We went through like 15, 16 questions there.
It's 135 too.
It's pretty good.
Pretty good, yeah.
But I see if we have some that came through. We answered in the Zoom thing here. I don't think we have any other questions pending.
Any from our live studio audience? Yes, Charles.
I don't think that.
Yeah. So the question coming through is on the private financing side. Have we looked at a scenario where we're using investor dollars as debt as opposed to getting bank financing, essentially? And we look at bank financing now. If interest rates are 7% from a bank, when you mix in principal and you mix in fees that the bank is going to charge to go get a loan, you're going to be north of 10% from a payment standpoint. So it's essentially, could an investor come in and take that 10% coupon instead of taking it from a bank? And definitely we've looked at saying, okay, is that something that we can, it doesn't work in our current operating structure. I mean, we have to make a new operating agreement that has that outline where we have 2 classes of investors. One that's getting a debt-like payment on a monthly basis, that's interest and principal, and another one that's getting the, upside cash flow and then future gains. So we've looked at doing that. We've certainly looked at doing that on the retail side where it's the cash flows are a lot cleaner with more known outcomes so that we can model out what that looks like.
We spent a lot of time looking at it, and really it just amounts to when can we get investors interested in being debt on a deal. So if we offer investors 2% interest on a deal, they're going to say, no.
Yeah, it's like, we're not going to do that.
So, we're not going to do that because you can go to the bank down the street, you get a 4% CD. And so then the big question is, if we're going to pay our investors more than what a CD would be paying down on the street. CDs are paying 4 or 5% now. So we have to pay investors obviously more than that. So 6, 7, 8%. But then the more we pay our investors, then the less the deal makes sense. So there's this kind of balance we have to kind of find that makes it all make sense. And that balance is, it's hard to find because then you have to find the deal that actually matches that. So if we're buying a deal at say a 7.5 cap and we're offering investors an 8% yield on the debt part, we're upside down. It doesn't work. But if we're buying the deal at a 9 cap and offering investors 7.5% or 8%, then that actually does work.
Yeah. So yeah, I mean, Charles, we've been trying to find like, how can we find scenarios where this makes sense? I think there's a pretty solid case, or if you're going to take a first position debt, this isn't mezzanine preferred equity. This is investors taking a first position debt with say Dollar General as the backing tenant, and it's a 50% loan. It's like, it seems pretty safe. Like, is the Dollar General going to go down 50% in value? Even in that case, that debt side investor is still getting all the money back because they're getting, when a deal is sold, they're getting, the debt is paid off first. Just like any bank loan, the debt's getting paid off first. So we think it's a great potential structure going forwards to really fund one of these acquisitions with, for all intents and purposes, all equity, paid 2 different ways. One paid like debt, one paid like our standard equity tranche.
So if you do sell
We're looking at it for every deal. In fact, we looked at Dollar General to do this on right now. And really, it becomes a conversation of how much is the bank going to offer us? How much will investors invest in? And then which is going to be the most competitive sort of rate? And, as Dave pointed out, even though the bank's advertising that the rate is 7%, the rate is really not 7%. It's higher than 7% because of the yield, the fees. And also there's a pain factor. Debt is painful. And so if we don't have that pain factor in the deal, it makes the deal actually easier to do also.
I mean, other lenders are also there isn't an interest rate. They're out of the game. Like they're saying, hey, we can't do loans right now. If they don't get anything paid off, they can't issue new debt. So that tightens up that market. So we can pay equity debt to investors. We can pay a higher rate because less transactions, we can probably get a better deal that we want to buy. But in that case, the Dollar General, we're looking at it, we didn't want to buy it. So we never got to the point of saying, hey, what does the debt side look like? Yeah, but we're excited to hopefully find something that fits that mold that we can send out, be a fairly unique structure, something that takes advantage of the opportunities that are out there right now.
Thanks for the question, Charles.
Cool. Okay, we don't have any other questions that came through. So thank you everyone for tuning in. If there's something else that comes after this, please email us, let us know. We'd be happy to go through it, but that concludes our second quarter. We're a month into the third quarter already, so we're excited about the third quarter and how it's progressing. So thanks, everyone.
For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.